Welcome to Smith Weekly Discussions, an occasional program for our members of Smith Weekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience of Smith Weekly, including Todd A., Ryan S., Jared A., and Nick W. A returning guest on the show today, Matt Geiger, is here with us. Matt is the managing partner of MJG Capital, a natural resource focused hedge fund based in San Francisco, California, United States. You can learn more about MJG Capital via their website. That's mjgcapital.com. Mr. Geiger, how are things with you?
Things are all right, Andrew. I appreciate you having me back on the program here. And after a few weeks of working furiously on the fund's latest investor update, I've now emerged from my writer's dungeon. So life is good. And as you mentioned, any listeners can go to the MJG website if they'd like to read the most recent update. It's posted under the investor letter tabs.
Excellent, Matt. I appreciate it. Thanks for coming back. Why don't we kick that off here? I mean, I want to roll through, a number of commodities here with you, but why don't we start out with maybe just giving the audience a quick overview of your latest letter to investors?
Well, the MJG Fund, for your listeners, is based out of the San Francisco area. We have a full natural resource mandate and a 10-year lockup for all investors. It's very long-term focused, natural resource oriented. We're long only, and we'll hold a concentrated position of between 15 to 25 names at any given time. And right now we're at 22 after a recent sale. Publicly traded positions, as well as one private investment in a handful of warrants that are in the money and a handful of warrants that are not in the money. So that's kind of our jam. In terms of the investment psychology, it's very much people focused, and so I try to look at this on very much from a bottom up basis. When I'm looking at a company, I try as much as possible to actually put the target commodity out of sight, out of mind, and focus on who's involved. Are they properly incentivized? Have they put up their own money into this deal? Are they up 5 or 10x on their investment already? Or are you able to get in on the same level? And then look at the asset. Is this a high quality asset? Could this, in theory, be built at the current metal price, or even below current metal prices? Do they have enough money to get through the next milestones? And is there value, et cetera? Then you look at the company structure, upcoming milestones, price to value metrics, the jurisdictional fit within your current portfolio. I'd say I'm generally pretty lenient for jurisdictional risk, as long as we don't have too many eggs in any given basket. And only then do I really look at the commodity of focus. Find that a lot of investors in this space, find themselves chasing the flavor of the weak commodity, and some folks are good at it, but generally that's not a recipe for success. And it's really the kind of temptation for newcomers into the space in particular, of which we've seen a lot of over the past six to 12 months. Generalists coming in, retail investors coming in, ESG focused investors coming into certain niches of the mining space. So just a word of caution. I think this is the better approach to go as an investor in this space. I guess one point of note, and thing that I emphasized in the letter, is that we're in we have a double-digit cash position now for the first time in a long time. The fund generally runs pretty fully deployed at any given time. However, because of we're in a weird paradox here for resource investors. On the one hand, from a mining perspective, over the coming 5-10 years, the setup couldn't look better. On a whole handful of metrics, whether you're looking at commodity prices specifically, or natural resource equities generally, or natural resource equities X energy, so really just mining, we are at or near 100-year lows when compared to the general stock market, when compared to the S&P 500. So I'm a big believer in reversion to the mean. It never happens as quickly as you anticipate. It's never a smooth ride, but I think this has to reconcile at some point over the coming years here. That said, the concern is what we're seeing in the general markets and across most other asset classes. And there's a plethora of anecdotal evidence out there that's concerning. Whether it's the return of retail investors and mass, through platforms like Robinhood, or the Reddit fueled, meme stocks that have proliferated since the coronavirus panic, or cryptocurrency and SPAC crazes. The spread between value and growth, it just goes on and on. So I'm in this weird position where I feel very excited about where we sit here, looking out 4 or 5 10 years, but in the immediate term, I think investors have to confront at least the possibility that there's going to be a broad market pullback, because things do seem to be a little bit in fairy tale land at the moment here. And even if this large pullback occurs, it can be at no fault of the resource industry at all, which in the scheme of things is actually relatively well behaved at the moment in terms of capital discipline and keeping G&A low, not making too stupid of acquisitions. But even if it's at no fault of their own, when we have this next big risk off event, us as mining focused or resource focused investors are going to get hit right on the chin. And we have to recognize that and know that there at some point here is going to be 30 or 40% drawdowns in short order, like we saw back in spring of 2020. So I think it's psychologically important for folks to position themselves for that, especially investors that may be listening to this program that haven't been in the mining space for all too long, don't understand the volatility and the cyclicality that's inherent in this space.
Matt, I suspect that you're in the camp of everything gets sold in this initial event, and maybe at some point in the future we see some type of event where it's 2001, 2002 type scenario. The broad market air comes out, but natural resources hold strong and start moving up. Maybe that doesn't happen. I'm not sure. It's really hard to tell, but I do think with just the over leveraging that's in the broad market, I do think that completely spills over, and natural resources across the board get whacked. And as we've seen things like silver and gold sentiment air has come out. And just recently, since the run up, the equity prices of uranium since November, we've seen the air come out of that to the tune of at least 30%. So it's going to be interesting to see how that goes. I am in the camp that initially that we all get whacked. And in our opportunities letter, we're sitting around 34% cash. And I feel like sometimes if this is like COVID 2020, I feel like this is not enough. This is not enough cash. So it is concerning, and we've been a little bit penalized for having too much cash, and then also people not necessarily happy with having that kind of cash in their portfolio, whether or not they're following what we're saying or not, I don't know. But it is a bit of a concern. And I think overall, though, I think we're in a pretty good position.
I think that's right. I mean, you touched on a few points there. I will say, yes, I think that assumption as an investor has to be that everything's going to be sold off in mass. And if we're surprised, then great. But history tells us that that's almost always the case. It's also probably worth noting that especially on the equity side of things, some of these metals that have seen a lot of speculative attention in recent months, and uranium, of course, there's been a pullback over the past 4 weeks, but I put uranium into the category. I put tin into that category. Those equities could be hit a lot harder because there is speculative premium built into them, compared to gold, which is kind of fallen out of favor here over the past 8 or 9 months, or something like zinc, which is about as contrarian as you can get for a metal. It's possible that downside in this pullback scenario will be a little bit less in these out of favor metals, but yes, as an investor, assume the worst. You can hope for the best, but I think you'll be rewarded for holding on to that cash position. But it can be psychologically difficult because there's nothing stopping this market from continuing to march higher for another 18 months. And I think anybody holding decently, outsized cash positions needs to understand that that's within the realm of possibility, and not make the worst possible mistake, which is to stick with it, for 12 months, say throw in the towel. And of course, right when you do that and go to fully deploy, that's right when the top of the market will be. So if you're going the cash route, you got to stick with it. So I'm prepared for us to be, we're in the mid-teens currently, and I'm prepared for us to be sitting in the region of 20% cash, for the foreseeable future here. And when it's ready to deploy and we're ready to go back to 5% cash, we'll know it. There's not a specific number that I'm looking for, but we'll know it. You'll have that pit in your stomach and wake up on multiple consecutive mornings and see half of your portfolio down 8 or 10%. And there will be another time like that. I'm not sure when that will be, but there will be another time. And then the few of us that do have a cash dry powder set to the side, that'll give us the conviction to hang on to our existing positions, and then also the opportunity to take advantage of some bargain prices. So we'll see how it plays out, but I'm comfortable to be wrong for quite some time on this cash front.
Yeah, absolutely. And the interesting thing here is specifically in the gold sector, some of these are getting very, very cheap. You almost want to deploy more capital in some of that right now, given that copper's a little bit in correction mode here, and some of these other places are probably still in that mode. But some of the gold equities here, Matt, I've just been surprised how much air's come out. And gold, the underlying metal, is actually holding up pretty well. You said something else, and so you have an advantage over normal investor, is that you have a fund and that you might have a potential waiting list that may be bigger and smaller at different times throughout the year. But should you need to raise capital, you could let in some of those investors in the door. So for a guy like yourself, if you guys get a little bit low on cash and you have people knocking, you can potentially expand that cash base. I'm sure you've done that in the past.
That's right. That is an advantage. I mean, so within an open-ended limited partnership, which is the way MJG is structured, there's really 3 different ways to build your cash position. One would be, of course, to trim or liquidate holdings in order to build that cash, and we've been doing a fair amount of that over the past 6 months with increasing frequency over the past 90 days. The second way is to have a takeout or two, which I'm hopeful for. I think there is a possibility that one of our holdings, probably Adriatic, and I mentioned this in the letters, is probably top of the list in terms of most likely to move within the portfolio, but we'll see. That's a whole nother rabbit hole to go down to, but I trust Paul Cronin tremendously there to make the right decision on behalf of shareholders. But a buyout, a cash buyout, or a buyout in scrip, and then liquidating that is a second way for us to raise our cash position. And then the third is is an open-ended partnership where we're taking on new investors at the first of each month. So there are scenarios, especially if inflows are strong, where we don't have to sell any names, and just by virtue of the new investors coming in, we can boost our cash position from low levels, closer to my goal of 20% here in the next 3 to 6 months.
Yeah, on the buyout front, hopefully there'll be some activity on that, and it's no secret over here that we expect some type of a purchase of Lumina Gold in our portfolio, and that gets done, and that should easily be a nice, not something substantial, but certainly a nice return and a low risk return, that there will be some type of a takeout at a premium to current prices.
I will say quickly, Andrew. I mean, this has been psychologically difficult. This is not easy, especially in a space like the natural resource space. I mean, there's 4,000 to 5,000 different opportunities for us to sort through. And another thing that's contingent upon, or necessary for you to properly raise cash, is to not be deployed into all too many new names. So in the first half of this year, we only made 2 new investments, both via private placement. And that's kind of the lowest volume that we've had in terms of initiating new names, really since the fund's inception. And I imagine it's going to be going at this slower pace, where we'll take one shot per quarter at most, until that next big sell-off event, and then there could be an opportunity to add 4 or 5 names that have been on the watch list in short order, when there's blood in the streets. But we're not nearly there yet.
So talk about for a moment, Strategic Resources was in the letter. Just maybe give a broad overview on why you think that was a good add at this level. Our members probably know a little bit about this company given our past Lumina group event, but maybe just talk about why now for Strategic.
Yeah, so Strategic's an interesting one, and it's as we mentioned, there's a 12-page write-up, I believe, in the investor letter, so folks can check that out. And I say right up front, strategic's unique within the MJG portfolio because I would classify this as a tried and true optionality play. You know, this is a bet on higher vanadium prices, and there's no really beating around the bush on that. This is not a style of investing that we do very much at all within the MJG Capital Fund. There's really only one other holding that I would say falls into that bucket at the moment, aside from strategic. So kind of putting that point aside for a second, I do think it checks all the rest of the boxes that we look for new investments, and that starts right at top with the people. This is a Lumina Group backed company. Lumina Group was founded by Ross Beatty in the early 2000s, and they've generated over $1.5 billion of exits for shareholders here over the past 2 decades. Prolifically successful. And also another important point about this group is it doesn't happen often, but in scenarios where they don't knock it out of the park or have that, A+ outcome that they were hoping for, they stick with their shareholders, and that's very rare amongst the junior space. You'll often see management teams, jumping from one vehicle to another at the first sign of trouble. So I have tremendous respect for the group, whether it's Mr. Beatty himself, whether it's Marshall Koval, whether it's Scott Hicks, who's the CEO at Strategic, Lyle Bratton, Martin Ripp. They have a team there that they've assembled that covers all aspects of mining. There's the accounting, the capital market side of things. Leo Hathaway, of course, doing the geology. Marshall Koval, very experienced mining engineer. So they really check all the boxes there. Lumina Group currently has 3 vehicles, and as you mentioned, you had them on just a few months ago, I believe, and did an in-depth interview. And you touched on all 3 of those vehicles. The flagship, of course, is Lumina Gold, a 250 million or so odd company with a development stage Cangrejos asset in Ecuador. It's been publicly known since really the beginning of 2020. I think Ross Beatty announced it at the Vancouver Resource Conference that Lumina Gold is soon to be sold. And it didn't happen in 2020. I think that's probably understandable with the Ecuadorian presidential elections coming up in the spring of 2021. But now that that's occurred, we have the new president in place. He's right wing, moderate right wing, pro business. I think the time is nigh for Lumina to monetize their asset now that there's 3 or 4 years of somewhat political certainty on the federal level, at least in Ecuador. Then they have a prospect generator within Ecuador, Luminex, and then Strategic, who's kind of the ugly stepchild at the moment, not very followed clearly based on the company's valuation of 11 million Canadian and the liquidity we see there. But once Lumina is out the door, Strategic will be down to 2 vehicles, and there's the Ecuadorian prospect generator, and then there's Strategic, and I think more eyeballs are going to come onto this story, both from the Lumina Gold perspective and also as vanadium heats up. And it may take years, but this is a metal that's characterized by price spikes once or twice a decade. Taking a step back before we go down the vanadium route, the company owns a couple assets in Finland. One of them is a brownfield asset called Mustavara, which between the mid 70s and mid 80s, a period of 9 or 10 years there, produced 10% of the world's vanadium supply. So it was a substantial producer on a global stage. And lots of money has gone into the ground there. There's still a historic resource. The mine site's actually permitted through mining and concentration on site. So that's an important advantage that it has over the vast majority of other development projects out there, both vanadium and otherwise. And they just came out with a PEA at Mustavara earlier this spring. I will say the numbers didn't jump off the page, and the market's reaction to the PEA said as much. But I think most investors that have looked at this closely knew that this was, the quote unquote optionality play, where this is not a project that works at spot prices, ferrovanadium prices or pig iron. It's actually getting closer because the prices of both of those materials are up a good 30% just in the past 6 months. So we're headed in the right direction, but still, you're betting on moves in those two specific metals. Should that occur, and again, vanadium in particular, the prices of both vanadium pentoxide and ferrovanadium would have to more than triple to see the levels that last seen in 2018. This is a project that on paper will be spitting, it already spits out a 400 million or so odd euro NPV, and at higher prices, it's massive. And the company's getting traded at, or trading at roughly 0.01x NPV multiple at the moment. So again, this is a pretty asymmetric bet if metal prices work in investors' favors. But I think the other important aspect is you've got the team, you're able to get in at the same valuation as this team, and that's an extremely important point. Ross Beatty is the largest individual shareholder here, and it's pretty well known that he first got involved in a 23-cent placement, which came with no warrant sweetener. And when I pressed send on the investor letter earlier this week, that's where the strategic share price was sitting, right at 23 cents. You're literally able to get in to a $10 million vehicle alongside Ross Beatty at the exact same cost basis. That's not a bad position to be in. And it's also important to note that the share price fell, I think, to an absolute low of 18 cents during the depths of the coronavirus driven sell-off last year. And we're not sitting too far from those 52-week low levels either. So there's very little speculative premium, if anything, baked into the company at current. And I think it's a good opportunity to align yourself with some very smart people who, mind you, have executed the optionality business model itself successfully through Lumina Copper. That's another important point. This is not something that they're trying for the first time. They created hundreds of millions of dollars worth of value doing this very same thing. Going out into a bad market, buying large, low-grade copper assets for pennies on the dollar that had already seen historical drilling and development expenditures, and then giving a little bit of time and monetizing them when the market swung in their favor. So I think there's a lot to like here, but again, it's unique in the fact that it's optionality play. That's not generally our MO with MJG, and it's also our smallest holding in terms of market cap. So I think that's another important note here.
Yeah, Matt, this is great. And this one certainly, while we don't own it officially as a recommendation, I'm very comfortable with these prices. And this setup is incredibly good. And the market cap of the company is just bottom of the barrel here. Sure, can it go a little bit lower during some liquidity events? Absolutely. But those should be met with buying. It's something that's been on our radar, obviously, because we track the group and we've had some prior events with them, and also they've been on the podcast. But certainly it's one that people should have on their radar or should actually just be buying at this point. So let's move on here for a moment. Let's go ahead and kind of touch on a few other items. You mentioned prospect generators in your reference back to Luminex. Come back to that for a sec on prospect generators, because it's not something that we've been terribly attracted to. I would say in our portfolio, it's not hugely important that we have them, although Luminex is a portfolio company. Those prospect generators, Matt, have kind of fallen out of bed, essentially. I mean, it's just not something that's been extremely liked by investors. Doesn't matter what commodity, it just doesn't seem like it's getting a lot of traction. And what do you think? Is the model dead, or is there just some metrics we should look for? I mean, obviously at some point they get cheap enough to where it makes sense.
Well, I think you're right. I mean, there's no question that prospect generators have been out of favor for at least a decade, and you could make an argument that maybe even a couple decades here. Because even during the 2002 to 2007 or 2011, depending on how you want to define it, China-driven commodity super cycle, that was not a discovery-driven market. A lot of the assets that were advanced and put into production over that period were already discovered, before the 2000s, and already had seen significant expenditures. And it was more these assets starting to work at higher metal prices, as simple as that. And so we have had this, decade to 2 decade long period where the major producers have really replenished their reserves, either by A, advancing these later stage development projects that were already discovered well before the turn of the century, and B, probably more importantly, continually lowering cutoff grades, which was justified by increasing metal prices. But it's a little bit of a shortcut, and you eventually push that too far. And I think it's clear across the board. I mean, a metal like copper is an obvious example, but for a lot of these metals, if the major producers are going to be able to keep pace with projected demand growth, there's going to need to be significant discoveries, and these discoveries are going to need to be advanced into production pretty quickly here. And so I do think we're going to actually see the pendulum swing back, and I'm more optimistic on PGs than I've been in some time. It is, to be fair, a business model that's always appealed to me. I think it's built to minimize dilution, which is arguably the number one enemy of investors in this space. I guess the other competition for that would be unethical people, and there's a lot of them in this industry. But that aside, it appeals to me that it's designed to limit dilution while still giving you the upside through the exploration game. And yeah, maybe if there's a major discovery, you'll only own 20% of it, or you'll only own a healthy royalty at the end of the day versus 100%. But you get a bunch of shots on target, and it's just an intelligent way to go about mineral exploration. But I do concede your point completely. It's been out of favor, and investors that have been in this neck of the woods generally have not been rewarded in recent years. That said, as I mentioned with these major producers, like they've over the past 10 years, past 20 years, they slashed their exploration budgets, they laid off their teams. They have very little infrastructure in place for a lot of these companies to go out and do proper exploration. So my hunch here is that we are going to see a lot more activity and deal volume between these larger parties and the prospect generators, and of course, yes, some junior explorers as well. But whether it's strategic alliances, exploring for a certain metal, over a large regional focus, whether it's a joint venture or an earn-in deal for a specific project, whether it's a sale from the prospect generator to a bigger party and the retention of a royalty. I think we're going to see this deal volume pick up in over the coming years. And as you mentioned, these companies are out of style, and in a lot of cases, there are some interesting names out there that are trading close to their working capital position. A lot of coverage of market cap. One holding we wrote about in the MJG investor letter, Golden Valley Mines, is literally trading at a 25% discount to its cash and marketable securities at the moment. And so, there are advantages of peeking around these out of favor niches of the market. And if the pendulum does swing back, I think there's excitement ahead. When I do look at these companies, and you mentioned metrics, I think this could be interesting to your listeners. Aside from all the good stuff that I mentioned earlier that we look at, the people, are they focused on their core competency? Are they properly incentivized? Are you getting in at a similar level to them? Asset quality, is it interesting? Is there scale, company structure, yada yada? There are three metrics that are unique to prospect generators that I'd recommend that folks look at. If they're lining up the PGs, 1 through 40, and are kind of evaluating what's the cream of the crop. The first one that I look at is the company's working capital position. So we'll say cash plus marketable securities minus any liabilities when compared to their market cap. And that's a measure of downside risk. Of course, companies can, Golden Valley is an example, get to the point where their market cap does drop below their quote unquote liquidation value. But from my perspective, that's a good rule of thumb to get a sense of whether a company has 30% downside or 80% downside if shit really hits the fan. So that's the first, and a measure of downside risk. Then I'll look at the company's runway to the next financing, which is basically their working capital position divided by their monthly burn, all-in monthly burn. And that'll give you a sense of how long you can expect the company to go without incurring any more share dilution. And for a lot of these companies, Golden Valley included, you may never see a financing. There's no reason to with the healthy cash and working capital position. As long as they stay adhere to the business model, you as a shareholder can be confident that the share count is going to stay very, very constant. But anyhow, looking at this runway will give you a sense of the dilution risk. And as I mentioned, that's extremely important variable here to, as an investor in this space. And then the third metric that I look at is the company's expected synthetic revenue relative to their enterprise value. And synthetic revenue, fancy name, coined by Rick Rule originally, I believe, but it's a simple concept. It's simply how much money is going to be put into the ground by said prospect generators partners over the next 12 months. And looking at that relative to the company's enterprise value, or the implied value of the company, gives you a sense of value and how much bang for your buck are you getting. So, for investors that are intrigued by this niche of the market and are, maybe narrowed their list down to 12 or 15, prospect generators with highly qualified, well-incentivized management teams, these are a few different metrics you can look at to kind of pick and choose maybe the 3 or 4 that you actually want to add to your portfolio. So I found these quite helpful over the years.
Matt, that's excellent. That's good information. Hopefully the audience took some notes there. I like specifically on the discount to cash. I think that one's an interesting one to point out. I think people should be careful with it. It applies very well to the example you provided, Golden Valley, but then it also is a very good indicator also of companies that are just completely wasteful. And if they're trading at significant discounts to their cash values because investors expect that they will blow that money.
Mm-hmm. No, that's exactly right. It's a potential opportunity when you see a company
sure.
trade below its liquidation value, but it's not automatically an opportunity. When you see that, the
Correct.
next question is, there must be something wrong here. What is it? And if you
Yes.
spend 12 hours talking to shareholders, talking to management, and you're still scratching your head, then maybe there is just an opportunity. More often than not, though, there is a problem. But going back to the Golden Valley Mines example, I know CEO Glenn Mullen very well. He's clearly not done an amazing job promoting the company, even though he does put effort into that. But he has a track record of discovery. He's been part of 2 major discoveries in Quebec, where Golden Valley is focused. Nunavik nickel originally, and then the Canadian Malartic itself. He staked a fair amount of that original land package. He's president of PDAC for a couple years. He's clearly respected within the industry, and the company's priced as if he's a crook, and that's simply not the case. So sometimes you will be able to find diamonds in the rough, but I think a proper amount of skepticism is warranted. Absolutely.
Well, Matt, just for the sake of time here, I know that you've got a tight schedule, but let's skip on gold because I think we've beat that to death enough already where we think that is. But why don't I start out here and let's try to rapidly cut through these. But I want to start out with you just giving your quick view on the current uranium environment.
Okay, well, I do have a tendency to pontificate, so I'll do my best to be concise. In short, and I think we're actually a little bit different in this. I think you're more optimistic on uranium prices, but I'll let you speak for yourself. But my base case assumption is that over these next 3, 4, 5 years, we will see $50 to $60 uranium. But I think at this point it's greedy to expect that it overshoots. I hope it overshoots. I think it's quite possible that it'll overshoot. But as a prudent speculator, I don't think you want to be betting on $150 uranium. And maybe I'll be eating my hat here in a couple of years. That remains to be seen. But there's so many pounds that have already been discovered that are sitting undeveloped, across the basin, across the United States, across Kazakhstan. I think there is a flood of supply that would be incentivized at these prices. Moving on to the actual equities, we touched on earlier that there's been pretty healthy pullback here over the past 5, 6, 7 weeks. I think it's fair to say that the Taishan nuclear plant leak that was reported originally mid June, I think it was June 14th, June 15th. That is the temporary peak, I believe, for uranium equities. I'm not saying it should be, but you got to a point where there was so much excitement amongst the uranium or the junior complex. So many folks that had never invested in mining before, haven't in years, plowing into the space, retail investors, traders, ESG focused investors. And to be fair, the spot price, nor contracting volumes from what I could tell from afar, we're picking up in a degree to justify some of these price moves. I mean, a lot of even the high quality juniors out there were being valued at 1x NPV multiples, assuming $60 uranium. So there's a lot of move in the uranium price already priced in. That said, there have been some positive developments here, even during this temporary pullback. Which, to be clear, if I had to guess, and I really try to stay out of the prediction business as much as I can, but it would make sense for this pullback, consolidation period, correction, however you want to describe it, probably last into the November timeframe. That's generally when you'll see seasonally uranium equities and the price of uranium itself pick up. That seems to happen almost every year. So that's probably how it will play out. That said, with the Sprott Physical Uranium Trust, Sprott's household name within the North American mining space. We use them as our kind of specialist broker for private placements. I have a lot of respect for that group. They're taking over UPC, and this is gonna become a major physical trust. And Sprott, with its trust structure, has some key advantages over UPC beyond the brand name. Most significantly is the fact that they'll be able to do at the market purchases. So we're gonna see a lot of uranium sucked up by this group over the coming months and years. I think Darren Millmeister from Extract Capital in his recent investor letter was right when he said, this is equivalent to, a large utility or two joining the market. I think that will be the ultimate effect. So that's a positive. And then, as many of your listeners will know, Kazatomprom came out in the past few weeks, and extended their 20% production cut through another year, which I think caught some market observers by surprise. So they're not going to go up to nameplate until early 2024 at the very earliest. And then, of course, there was the major fires around Cigar Lake, which got a lot of press and social media coverage. It didn't end up damaging the operation, so it was a narrow miss. But I think, too, a lot of folks that went and further emphasized the fragility of the uranium supply chain, is something that folks will keep in mind here going forward. In terms of the MJG fund, I mean, we really only have one major uranium position at the moment, at around 6% of the overall portfolio. That's Global Atomic. It's been a very large winner for us. First buying shares in the 40-cent range. Participated in a 60-cent placement in size last year. And I think, look, there's a lot of geopolitical risk there. We have no other exposure to Niger, which I think is an important point to emphasize. But their advantage, of course, is being fully permitted, and there's not many high quality development assets out there that look good on paper at reasonable uranium prices that already have that permit in hand. So that's a name that we'll stick with. Management's done a great job there. We have taken profits, to be fair. I mean, it was close to a 15% position at one point in the past few months. And I think there is room for another uranium name to be added to the portfolio, kind of in this fall period as we head into November, maybe September, October. I don't want to get too cute here, whether it's owning the physical trust itself, or whether it's looking at Kazatomprom, or sticking to the 4 or 5 high quality later stage development assets that may or may not be permitted, or if it's not permitted, would probably be NextGen's Arrow is a name on it's closer to our watch list. So I don't want to get too cute with uranium. Maybe we'll be leaving money on the table because of that. But that's kind of where I stand on the metal at the moment.
Well, you took most of the time away on that, but we've got to cover a few other items. The one thing I would say is I think we disagree a little bit on the finer details here, and probably could have a longer conversation about some of the individual equities for another time.
Sure.
But I do agree with you. If uranium was at $60 and stayed there for 3 years, your point's valid. Anything less than that, no, it doesn't work. And that just comes down to having some conservative factors on what mines will start and what mines get developed at that price, how long it takes to develop, and all that stuff. You have a good view there, and congratulations on some of your wins there. And we've done pretty well. Of course, it never meets expectations. We're always trying for better, but another leg up here at some point. But it could be some time of pain before that starts.
I should have noted, I think it was a sign that the market was maybe getting a little ahead of itself, at least on the equity side of things, when you saw groups like Denison and UEC, Boss. I know there are a couple others that I'm blanking on, but go out into the market and buy physical uranium. I'm not saying that that was a foolish decision from the company's perspective. It could have actually been a very smart decision from that company's management. But what it was saying clearly to me is at that point in time, they thought that physical uranium was a better investment than their own shares. And I don't think a lot of folks, read it that way. That's a less charitable interpretation. But I think in hindsight, that's what was happening at that time.
And I have mixed views on it, both some positive depending on the company, and then of course negative depending on what company we're talking about. But you'll see also that some companies did not do that and will not do that at all going forward. There's certainly a difference in policy there, and I think you pointed it out, and it's right to point that out, that some it makes some sense for, and then others it just doesn't at all.
Right.
And it was nothing more than a show. In some case, there was just some following the coattails of others. MPVs, certainly some of these got out of hand. I'm not saying the market doesn't start looking forward in a heavy way. That will certainly happen. But at current prices, the MPVs are negative. It's always interesting to point that out. It just gives me a chuckle. And I'm terribly, terribly bullish on uranium, but I also have to have a humble view. Well, let's leave it there on that. I want to move on to the next one. I want to get your quick view. Vanadium's covered. We're done. Let's move on to tin here for a moment. I'd like to get your quick view on tin.
Tin, the flavor of the month. I'm seeing a lot of chatter out there, and for good reason. We don't have any tin exposure within the MJG portfolio. That's not by design. That's more just I didn't come across an opportunity at the right time that made sense relative to the rest of the opportunities that were on our plate, both within the existing portfolio and in terms of new positions that could be added. Obviously we've seen tin prices hit all-time highs here just in very recently in the past few weeks. Metal has been absolutely on fire. Its primary application is as soldering for electronics and semiconductors. So some pretty sexy applications you could say, and as far as metals go. Another important point here that's not lost on people following the space is exploration and development expenditures, focused on tin have been depressed for decades now. It was thought of as by many folks as a metal that was going out of favor and not worth exploring for. So you're left in the situation where the majority of supply is coming from relatively unsavory jurisdictions, and there aren't too many large scale development projects that are out there ready to be built, or even within reasonable proximity to be ready to be built. One interesting piece of data that a lot of folks point to is the Rio Tinto study that they commissioned alongside MIT, and MIT determined that tin actually as a metal was most positively impacted by new technology out of any metal, and I think lithium, cobalt, silver, and nickel, I believe, rounded out the top five there. But that's been some ammo kind of in the back pocket of tin bulls. There's very few vehicles for tin exposure. There's the producers, Metals X, with their operation down in Tasmania. Alphamin is definitely a name that I'm following. It's interesting. It's cheap. I think at the moment it's at a 30% free cash flow yield. After recent moves in recent days, it might be a little bit lower than that, but it's still it's cheap for the amount of cash that they're generating. That said, there's a lot of chatter about it, and this might be a strength for me as an investor. This might be a flaw for me as an investor. It's probably a mix of both. But when I see a lot of chatter and excitement about a given name or a given sector or a given metal, for me that's a turn off if I'm not already positioned in that specific story. So Alphamin kind of falls into that category. I'll also just say you have to have a pretty extreme stomach for geopolitical risk with that name. It's in the DRC. And within the DRC, it's in the scary part of the DRC, kind of the eastern part of the country there, right near Rwanda, right near Burundi, less desirable than even, where Kamoa-Kakula is operating, and other regions within what is a massive country. Another name out there, Strongbow. Well, it's now called Cornish Metals, I believe. We used to be Strongbow shareholders in 2016, 2017 timeframe. Their South Crofty project in the UK. That's an interesting one. I've seen some smart people talking about. That said, we exited the position because the company missed on a couple promised milestones and seem to be spinning their wheels there at the moment. So, as I mentioned, the biggest concern for me at the moment when it comes to tin is the buzz and excitement we're seeing across the space.
Right.
I'm generally allergic to these situations. Maybe in the next big market pullback where everything gets sold off in mass, that could be an opportunity to step in and make sure we have some tin exposure, but we don't at the moment.
Okay. Bullish or bearish comment only. First, start with oil. Bullish or bearish here?
You want it quick. We don't do oil and gas within the MJG fund. That's a whole discussion in itself. We have no hydrocarbon exposure. Have never had any hydrocarbon exposure. It's not for moralistic reasons. It's just due to the time frames that we're investing over. It's highly correlated with metals anyway. It's a different industry, different science, different people. So I'm sticking to my knitting and staying within the metal space. So no oil, gas, or coal exposure. No strong opinions there.
How about coal here?
Coal I would include in the hydrocarbon basket, so we don't have coal exposure either. Look, there's been a strong run amongst the equities after being insanely out of favor late last year, and it's been a long multi-year period for any of these coal focused companies. All of these older sources of energy are going to continue to have relevance globally until the day I die, as far as I'm concerned. Maybe I'll stand to be corrected here. I'm sure there's individual security opportunities amongst the coal space, but that's not a sandbox that we dabble in.
Any comments on carbon credits? I know that's hydrocarbon related to some degree, but carbon credits, any comments on the price of carbon credits going forward?
Look, I think it's an interesting space. You have folks like Marin Katusa out there, pounding the table on a daily basis to take a look. There aren't too many vehicles to play it. We do actually own a company called Star Royalties, which I think by market cap is the smallest of the gold silver focused royalty cos. A certain niche of their business, it's about 20%, is kind of their stated intent. Is focused on these carbon credit opportunities, and I'm hoping that they push the pedal to the metal there and spin that out sooner rather than later. There's another carbon credit vehicle that's out there. I'm not a fan of the people running it, but to their credit, they've been able to assemble a roster of high profile backers. But I'd like to see Star spin out their carbon credits business and go head to head with this group, because I think there's a lot of blue sky. And it's still early.
Okay. Any comments on the royalty companies here?
Royalty companies generally, well, it is a business model that is near and dear to my heart. As I mentioned, I'm allergic to dilution, and this is another one of those business models that seem to be handcrafted to avoid dilution as much as possible. I believe we're at about 20% of our weighted portfolio focused on royalty cos at the moment. I guess the one point I'll leave you with is I'm a lot more excited about the royalty companies that are focused outside of gold and silver. And don't get me wrong, the royalty business model has transformed the precious metal space over the past 2 decades. We have quite a healthy bit of exposure to various precious metal focused royalty companies. Golden Valley I consider a prospect generator, but because of their large equity position in Abitibi Royalties, you could just as easily consider that a royalty name. Alta Strategies is another one of these royalty generators in the portfolio. All that said, I'm excited about the names that are focused on metals outside of PMs, and it's a pretty small group of names. Anglo Pacific and Altius Minerals, which is a fund holding Altius is, come to mind as kind of heavyweights along with Labrador Iron Ore. But I think there's a lot of blue sky there. We've seen the precious metal royalty space go from a sub $1 billion industry to a 60 odd billion dollar industry today in 2 decades. If you look at the cumulative market cap of the non-precious metal focused royalty names, we're in the $4 or $5 billion range. So that doesn't seem to make sense to me. I mean, gold as a whole is only 15 to 20% of total value of metal that's pulled out of the ground on a given year. But this comparison between the royalty companies is much more extreme. We're talking an order of magnitude difference. A lot of folks will say there's good reason for this. I think you can make a compelling argument that the cash flow multiples that these non-precious metal royalty companies should receive, should be at par with precious metals. I mean, usually these base metal and energy metal operations are longer life than your average gold mine. We're talking 20, 30, 40 years versus 10, 15, or 20. And there's also fewer of them out there. I mean, gold is a much more fragmented industry. You have a lot more mines producing on a smaller basis. So yes, it's harder for a royalty company to break in if you're focusing on a metal like nickel, or a metal like copper, or a metal like uranium. But if you're able to do so, if you're the first mover, I think there's a lot of value there. So I'll leave your listeners with that. I mean, we do have Nova Royalty is a large holding of ours, and it's a company that I wrote about as the featured investment in our previous investor letter, and included an update on it in the most recent investor letter. We own a name like EMX Royalty, which has some precious metal royalty exposure, but has a good amount focused on copper and zinc and lead and nickel and some of these other metals. And then of course the aforementioned Altius Minerals is a holding of ours, and I can't speak more highly about Brian and the group there. That's kind of more of a buy and forget name, which is distinct from a lot of the other names in the MJG portfolio, where I'm tracking the news flow on a day-to-day basis. But Altius deserves a home in basically every investor's retirement accounts, for as far as I'm concerned. That to be fair is not a recommendation to your listeners, but I can say that in my retirement accounts, I own Altius in addition to within MJG.
Good points, Matt. Last thing, how can folks reach out to you that are interested in MJG, or just reaching out to contact you? Best way for that, and then also if you want to share any details, requirements to come onto the fund.
Sure. Yeah. I mean, you mentioned the website. There's a contact form there. That's www.mjgcapital.com. And you can also follow me on Twitter. The Twitter handle is Geiger Counting. Little play on the Geiger counter there. So that's Geiger Counting is the handle. And I'll share interviews and some thoughts on the market, as well as the fund's investor letters there. Yeah, the fund's structure is pretty simple. You have to have trust in me as an investor, in order to lock in. I'll admit that's a draconian lockup, but it's set us up with the structure to succeed in this space, as far as I'm concerned. And you have to be an accredited investor. So those are really the only two requirements. Happy to talk that over with any of your listeners if there's interest.
Matt, thanks for taking the time. Appreciate it. We'll have to do it again, and you stay well out there.
You too, Andrew. This has been fun. Thanks for having me on.